What if everything you think you own is actually holding you back from building true wealth? Based on the book Rich Dad, Poor Dad by Robert Kiyosaki, today we are going to debunk one of the biggest myths in personal finance, understanding the difference between assets and liabilities. Welcome to From Book to Life, where we turn great book ideas into practical lessons for your daily growth. By the end of this video, you'll see how small changes in the way you spend and invest can make all the difference between getting rich or staying stuck. If you're ready to take control of your financial future, hit like, share your thoughts in the comments, and subscribe for more real-world wisdom straight from the best books in the world. Our exploration of passive income and financial wisdom inspired by Rich Dad, Poor Dad, it is crucial to address a common misconception that often undermines personal wealth growth: the confusion between assets and liabilities. Many people mistakenly consider certain purchases as assets, when in reality they drain resources and act as financial burdens. This misunderstanding stems from advertising and societal norms that glorify ownership, leading consumers into financial traps disguised as smart investments. One of the most prevalent examples is the purchase of brand new financed cars. While a shiny new vehicle may feel like a symbol of achievement, its financial reality is much grimmer. The moment a new car rolls off the lot, it typically loses 20–30% of its value instantly, a drastic depreciation that continues over time. On top of that, high interest rates associated with car loans inflate the overall cost, while recurring monthly expenses such as insurance and maintenance only add to the financial strain. Instead of appreciating or providing passive value, these vehicles consume money steadily, making them clear liabilities rather than assets. Further compounding this situation, we encounter the relentless cycle of upgrading to the latest tech gadgets and electronics. Technology moves at a lightning pace, and what feels cutting edge today quickly becomes outdated tomorrow. This rapid obsolescence causes electronics to shed their resale value almost immediately, often leaving owners with items worth far less than initially paid. The pressure to keep up pushes consumers to continuously spend on upgrades, creating an endless outflow rather than any form of investment return. When viewed through the lens of financial literacy, these spending habits unmistakably fall into the passive category, detracting from long-term wealth. The allure of designer clothing and high-end accessories presents yet another subtle yet powerful form of disguised liability. These items, often perceived as status symbols or worthwhile splurges, suffer from extremely fast depreciation. Their high price is rarely matched by any enduring value, and once trends shift or the novelty wears off, their real worth plummets. The emotional drivers that fuel these purchases, such as the desire for validation or fleeting happiness, can lead individuals to spend far more than the lasting value they'll ever receive. Ultimately, brand name apparel and luxury accessories quietly erode savings and seldom appreciate, making them liabilities masquerading as assets. What unites all these examples is a pattern of emotional consumption and financial self-deception. Society often encourages us to measure our success by material possessions, yet the true impact of these purchases invisibly undermines our financial goals. By categorizing depreciating goods as assets, it's easy to justify spending decisions that actually subtract from, rather than contribute to, our net worth. This distortion in perception highlights the importance of a fundamental financial education, one that distinguishes between what puts money in your pocket and what quietly siphons it away. Recognizing these disguised liabilities is the first step toward a more informed and empowered financial future. When consumers begin to question the value and true cost of their purchases, they open the door to smarter, more intentional spending. This awareness doesn't mean denying oneself life's comforts, but rather making conscious decisions that align expenses with long-term financial aspirations. Ultimately, shifting our mindset about what constitutes an asset versus a liability is essential for building sustainable wealth and achieving genuine financial security. With this understanding of the hidden dangers and confusing liabilities for assets, it becomes even more essential to focus attention on accessible avenues for building genuine wealth. The journey toward financial growth does not have to start with large sums of money or exclusive opportunities reserved for the affluent. In fact, there are numerous low-cost investments within reach for almost anyone willing to adopt a disciplined and informed approach. These entry points, when chosen wisely, can lay a strong foundation for financial autonomy and gradual asset accumulation. A prime example lies in fractional shares, an innovation that has opened the door for everyday investors. Rather than feeling excluded by the high cost of popular stocks or ETFs, individuals can start investing with as little as $5 through platforms like Robinhood and Cash App. This approach democratizes access to diversified portfolios, enabling even those with limited funds to own a stake in major companies and reputable exchange-traded funds. The power to build wealth no longer depends on significant capital, but on consistency and the strategic allocation of resources, which can yield meaningful results over time as investments compound. Equally significant is the expansion of digital content creation as a viable asset. More than just a creative outlet, digital products such as online courses, ebooks, and original content can become enduring sources of revenue. Monetization channels like YouTube, Medium, Udemy, and Substack empower individuals to share their knowledge or talents while earning passive or semi-passive income in return. The upfront effort involved in producing valuable material is often repaid by ongoing earnings as content reaches wider audiences, making this not only a rewarding pursuit, but a practical means to convert skills and insights into financial assets. In addition to traditional securities and content creation, digital investments are carving out an increasingly important role in modern portfolios. Cryptocurrencies, for instance, allow beginners to participate with modest amounts, offering both potential upside and an opportunity to learn about evolving financial technologies. NFTs, while speculative, represent another frontier for those interested in digital ownership and the creator economy. Moreover, models such as crowdfunding and peer-to-peer lending platforms grant access to alternative investment streams. These options can diversify one's risk and bolster steady asset growth outside conventional markets. By seizing these avenues, individuals move beyond consumption-driven decisions and toward the empowering practice of asset accumulation. Small, regular investments, whether in stocks, creative projects, or digital innovations, capitalize on the principle that time in the market, more than the amount invested, determines ultimate financial growth. Importantly, these strategies allow for participation at any income level, affirming that the most critical factor is a willingness to start and the discipline to continue nurturing one's financial garden, regardless of its initial size. This philosophy also fosters a sense of agency and personal responsibility in shaping one's economic destiny. Rather than passively relying on fleeting trends or consumer goods for fulfillment, the practice of building accessible assets instills both patience and confidence in the journey to long-term prosperity. Over time, even modest investments can lead to transformational shifts, both in mindset and in net worth, as they reinforce positive habits and compound financial returns. Ultimately, these accessible investment strategies represent a pivotal shift from traditional paradigms of wealth building. They strip away excuses rooted in lack of capital or opportunity and instead invite anyone, regardless of background or current financial standing, to participate in meaningful asset growth. The path to financial freedom is no longer a distant privilege. It is an achievable goal, shaped by consistent, informed action and an openness to evolving opportunities. From this point on, the essential element that truly determines long-term financial success is not just the practical steps taken, but the underlying mindset shaping every decision. Adopting a wealth-building mentality means consistently prioritizing the acquisition of assets over liabilities. This principle, championed in Rich Dad, Poor Dad, rewires our approach to money. Every dollar set aside for investment becomes like a dedicated worker, quietly generating value and opportunity in the background, rather than merely being spent and lost. Embracing this outlook shifts daily choices in fundamental ways, from resisting fleeting temptations to seeking out opportunities that build sustainable income streams. This transformation also involves redefining how we measure worth. Rather than chasing status through outward displays and rapidly depreciating purchases, the focus moves to genuine value, assets that grow, protect, and provide liquidity. Liquidity, or the ease with which resources can adapt to new needs or opportunities, becomes far more meaningful than the fleeting satisfaction of extravagance. With each decision weighed against the criteria of value and practical utility, financial independence becomes less about luck or privilege, and more a function of consistent, informed choices. Fundamental to this new mentality is the understanding that meaningful change rarely arrives overnight. It is essential to start small, allowing even modest efforts and investments to build momentum. Taking consistent steps, however humble, ushers in gradual but profound transformation. This not only makes the process accessible to those with limited means, but also reinforces the habit of persistence, which is far more important than isolated one-time efforts. The compounding effect of regular contributions, paired with the discipline to reinvest returns, is what ultimately propels wealth forward. Education serves as a vital foundation for this evolution. Continuously seeking financial knowledge, staying attuned to new strategies, and learning from both successes and mistakes reinforce the ability to recognize and harness genuine opportunities. Knowledge acts as a shield against common pitfalls, empowering individuals to navigate risk with confidence rather than fear. Over time, a commitment to learning closes the gap between aspiration and achievement and nurtures a lasting sense of control over one's financial well-being. Equally crucial is the vigilant avoidance of impulse-driven consumption. The urge to satisfy immediate desires or to keep up with social pressures can quickly undermine carefully laid plans and drain resources meant for growth. A deliberate pause before each major purchase, coupled with a habit of questioning whether it aligns with long-term goals, creates a protective buffer around hard-won gains. In a culture that celebrates quick gratification, this restraint is a powerful counterforce, enabling more deliberate progress toward enduring financial security. Altogether, cultivating a wealth-oriented mindset, grounded in clear principles and ongoing self-awareness, becomes the true engine of sustainable financial transformation. It moves the individual from a passive participant in consumer culture to an active architect of their financial destiny, opening doors to opportunities once hidden behind misleading appearances of wealth. With patience, consistency, and education as allies, the journey to asset building becomes not only possible, but deeply rewarding. Following this idea of a value and growth-focused financial mindset, it's essential to apply these principles in a practical, everyday manner. One of the most powerful tools for this is creating a personal diagnostic spreadsheet designed to assess each item that currently makes up your assets. This approach discourages the unconscious accumulation of disguised liabilities and guides concrete actions to alter the composition of your possessions, aligning what you own with authentic wealth building. The spreadsheet acts as a true financial mirror, allowing every asset to be evaluated with honesty and clarity. For each item, simple yet incisive questions guide the analysis process. Does this item generate income? Does it have potential to appreciate over time? And is it truly essential or merely superfluous? By engaging in this self-diagnostic process, it quickly becomes clear which belongings contribute to financial progress and which, by their nature or function, simply consume resources and space. Beyond these central questions, factors like maintenance cost and resale potential deserve special attention. Some items may not seem problematic at first, but their recurring expenses, whether in time, money, or energy, end up being real drains on resources. Considering how easy it would be to resell an item also brings a realistic perspective of its liquidity. Assets with good resale value offer greater flexibility in times of need or when new opportunities arise. This evaluation process is not just about cutting expenses or getting rid of unnecessary things, but about consciously taking control of your wealth. The clear objective is to transform at least 70% of your items into legitimate assets, whether because they generate income, appreciate in value, or at least don't erode your resources. Achieving this goal requires both practical adjustments and a mindset open to ongoing change, allowing the makeup of your assets to evolve alongside your priorities and lessons learned. By making this analysis a habit, eliminating liabilities becomes increasingly natural. Items that don't fit the established criteria can be sold, donated, or discarded, freeing up physical, mental, and financial space for opportunities that are more closely aligned with your objectives. In this dynamic, every decision to keep, acquire, or discard something is evaluated not just from a material perspective, but also as a strategic choice for the long term. Thus, using a personal diagnostic spreadsheet goes far beyond simple inventory organization. It becomes a practical method of self-development and financial growth. By revisiting this analysis periodically, you stay connected to your goals and avoid falling back into impulsive consumption habits. This ongoing practice ensures that your time, energy, and money are increasingly linked to genuine assets, driving the construction of sustainable and conscious wealth. The biggest lesson from today's video: true wealth isn't about what you own, but about what your money earns for you. By focusing on accessible assets, breaking consumption habits, and applying simple strategies like the 50-30-20 rule, you can start building real financial freedom one smart choice at a time. I challenge you to look at your own life through this new lens. What can you transform into an asset today? Share your journey below, and if you found value here, don't forget to like, comment, and subscribe. Check out our other videos on From Book to Life for more insights to put your favorite books to work in your everyday life. Together, let's turn knowledge into action and dreams into results.